Hey guys, welcome back to the channel. Today I'm going to be covering a market cycle bottom prediction for Bitcoin by looking at the ratio of the cycle low to its previous cycle low. So what we're going to be doing is we're going to be looking at Bitcoin's previous market data and then hopefully identifying some sort of trend that we can use to look to help us predict or at least guide us as to where the next cycle low will be in terms of both price and time. So if you guys enjoy the content, please do consider leaving a like and subscribing. Also, by the way, this channel is sponsored by the cryptocurrency exchange FTX.us. This is a great cryptocurrency exchange for buying, selling, and trading cryptocurrencies like Bitcoin. And if you want to sign up with my link in the description below or through my referral code SNOWYCRYPTO, you can get a 5% discount on exchange fees. It is a great exchange. I do recommend checking them out. All right, so let's dive in here to Bitcoin. So I'm going to start off here with the first bear market for Bitcoin all the way back here in 2011 and look at the relationship between this low that we had at around $2 to the next low in 2015 that we had around $170. And one of the things that we can do is we can look at the percent return from these two values and you get a number around 8,200%. Meaning that from $2 to $170 from the 2011 cycle low to the 2015 cycle low, Bitcoin increased in value by around 8,200%. And we're going to be using this percent increase from cycle low to the next cycle low as a reference point to see if we can identify some sort of longer term trend for Bitcoin. Is there some sort of trend that we can help to use to help predict where the next bear market low could potentially be? And if we are continuing on to the next bear market low in 2018, we can identify the same percent return. And this one was much less. It was a 1,780% return to go from $170 to $3,100 from bottom in 2015 to the bottom in 2018. And one of the things that I'm noticing right off the bat here is that these numbers have decreased by a significant amount. If you were to take the difference, you would get around 5,500% less. But if we can't really use that to our advantage because 5,500% less from 1,780% is just going to give us a number far lower than negative 100%, which is the maximum downside. So we can't really use the difference, but what we can do is we can take the ratio. And if we were to take the ratio of the return from 2011 to 2015 and the return from 2015 to 2018, you get a number of 0.217, meaning that the return that you saw from this bear market low to this bear market low was basically 5 times greater than this bear market low in 2015 to the next one. And if we're continuing on and we were to say hypothetically, look to where that could potentially lead us into the next cycle low, what we can do here is we can take that same ratio and multiply it by 1,780%. And that's basically just to say that this trend is going to continue, that the returns are going to be diminishing by the same ratio, which clearly does not have to happen. That is most likely not going to happen. But what we're just doing here is using this as an exercise to help predict, well, okay, where is a reasonable target based on its historical returns? And again, if you were to do that, you would multiply 1,780 by 0.217, that ratio, and you get a 386% return. Now, increasing 386% in value from the 2018 cycle low at $3,100 gives you a value close to 15K. And that is to say that if the ratios from the bottoms to the next bottoms were to remain constant, that is where the bottom for the next cycle low would be. And it's important to understand that that ratio, again, does not have to remain constant. Just because that's what we did in the past doesn't mean that's what we have to do in the future. But I think it's pretty interesting to look at the previous data, the previous market cycles, and use this ratio as a guide of what is a reasonable target, what is logical in terms of a market cycle bottom based on historical data and historical returns. And if we use this level at $15,000 in confluence with some other indicators, like say the 300-week simple moving average, I think you can start to increase that overall confidence of this being a longer-term area of value, of accumulation, and of demand. So also another thing that we can do is we can look at the time and use the time from the cycle bottoms to help predict where the next one could ultimately be. So I'm just going to zoom out here to get a little bit bigger of a picture here. And let's just look at the relationship between the time from cycle low to the next cycle low. So we can see here, this one was 165 bars. So 165 weeks to go from the bottom in November of 2011 to the bottom in January of 2015. And then from the January 2015 bottom to the next one in December of 2018, it was around 204 bars. So 204 weeks. Now we can do a few different things with these two data points. One of the things that we can do is realize that well, they've increased in value by about 40 weeks. So if you were to do that and say extend it out to 240 weeks out from the December 2018 cycle low, that would bring you to a cycle low in July of 2023. Another approach that you could take is you could take the average. You could say take 204 plus 165 and then divide that by 2, and that would give you around 184 weeks, which would mean that we already have a cycle low in place, and that would be around the middle of June. And that's actually where we do have our current low in place. Whether we go below that value or not, we'll have to wait and see. And then finally, if we wanted to take the average of 240 weeks out and 184 weeks out, you would get around 210 weeks out, which would bring you to a low towards the end of this year in December. And I think all of these are reasonable expectations. You can't specifically predict the exact bottom, but you can get a reasonable range, just like we did with the $15,000 area from a price standpoint. And overall, I do think this is a realistic level that we can look to, especially towards the end of the year, where potentially we could be nearing the end of this bear market and we could have that longer term cycle low. So I hope you guys did enjoy this analysis and this longer term outlook on Bitcoin. If you have any comments, suggestions, or feedback, please do leave those in the comments section below. As always, I hope you enjoyed, and I will see you in the next one.